So one of the things I mentioned I do is minimising tax. And some people think that tax is boring, but surely saving tax is not boring, because saving tax really is the same thing as making money.
You know, I really love super. Super is my life. And you know, super's been around for a long time. And as you know, there's lots of changes. It's always in the media now. Actually, super was not mainstream years ago. Now, every time we pick up a financial review, the Courier Mail, the Bulletin, there's something about super. Australia has arguably one of the best superannuation systems in the world, and a lot of people don't actually know what superannuation is. Superannuation is not an investment. What it is a piece of legislation, federal legislation, that allows taxpayers to take advantage of concessionally taxed rates.
So capital gains tax, you sell an asset, be it property or shares or something like that, and the capital gain really is just the difference between this is what I sold it for and this is what I bought it for, and the difference is your gain. It's a good time when you've got a capital gain to have a look at all your investments and go, okay, well these ones really haven't made any money, there's a loss. It might be a good time to crystallise, so that means sell it down and get that loss to offset against your capital gain in that financial year.
Michael, still working, he's on the highest tax bracket of say 46.5%, doing the Medicare levy. His salary sacrifices up to his age base limit, $35,000 into his superannuation, and saves tax in his own name of $11,025 a year. So that's a huge saving.
If you have dividends in your own name, okay, and you don't have much tax to pay on anything else, imputation credits, so dividend credits on shares that you receive, excess of those will be refunded to you, so you will get a tax refund of excess franking credits when you get shares. A lot of people just think it always has to be a 50% holding, and that's not the case. You know, we have clients with 90-10 or 99-1 or whatever, because one of them might have other income from somewhere else. So it might be best then to hold more of it in one person's name than the other name. So just be aware it doesn't have to be 50-50.
Remember personal contributions. You have an annual limit basically. It's $30,000 if you're under 50 and $35,000 a year if you're over 50. If you have a self-managed super fund, you can effectively put in 2 years' contributions in 1 year. But you can actually bring forward your 30, so if your age base limit is $35,000, you can actually put in $70,000 in 1 year. That means you can claim twice as much as a tax deduction in 1 year.
A discretionary trust. Discretionary trusts are really extremely common in Australia, both to operate a business through and to hold investments. They're really cool because the income can be split around. So the trust does a tax return and says, right, this is my income and expenses, this is the profit, and this is where it's going to be distributed. And it's discretionary because it's at the discretion of the trustee every year where that distribution goes. So it can change from year to year. So we advise our clients, okay, what income has everyone got in the family group? Because it can be your entire family group that we're talking about here. Children, grandchildren, nieces, nephews, and we can make a distribution to save tax in that way. So any beneficiaries that receive a distribution, just pick it up and pop it into their tax return, and again, they're taxed at whatever tax bracket that they are sitting in. So it's very flexible, they're not regulated like companies are with ASIC, they're very easy to use. And that distribution for tax purposes doesn't necessarily have to be a cash one. So we don't have to go, you know, to your grandchildren, here's your $416 of cash. That doesn't have to be that way, it's just for tax purposes.
But the greatest thing about being in pension mode is that there's no tax on the earnings of your super fund. Where else in the world can you have, and I'm just going to use this broadly, $1 million invested and not pay 1 cent in tax on the earnings?
So let's talk about gearing. So gearing really is just borrowing money, okay, so getting some lending, and the interest is tax deductible. So that interest is claimed and offset against your investment earnings. You've got excess cash. Should we pay down the home loan? Or shouldn't we pay down the home loan? Because everyone always just assumes, yeah, let's pay down the home loan. But if the home loan's 5% and you can invest that excess cash and get 12%, right, that could be a better option. It's important to know that you have to hold that share for a period of 45 days in order to get that franking credit. And that's particularly important for share traders who are turning over their shares quite frequently, because if you don't hold them for 45 days, you don't get any franking credit if there's been a dividend declared in that time period.
But this is sensational. Like, we've got clients that have $1 million in their super fund. They're getting $15,000 to $20,000 back a year when they do their tax return. I mean, that funds an overseas holiday every year for them. It's just sensational. And once you get to 65, basically, you get this thing called the final condition of release, or the preservation age, and you can just set up a pension. So you can be in accumulation mode and in pension mode at the same time. So you can be contributing to your super fund and drawing a pension.
The dividend reinvestment is me going, here you go, here's your dividend, and that's income to you right then. It goes into your tax return as a dividend, and you go, oh, well, don't give me the cash, get me some more shares instead. Okay, so that's a dividend reinvestment. It's income to you, you've received the dividend for tax purposes, even though you haven't got the cash, so it goes into your tax return, and then you've got some more shares. But there's no capital gain until you actually sell some of the shares.